September 16 of 1992 became known as the Black Wednesday because it was the day that the British government was forced to back off from the exchange rate mechanisms. That happened because the government was trying to buy its own currency artificially while heavy-duty speculators were shorting it vigorously. The most powerful of those speculators is a man called George Soros, and he profited $1 billion in the so-called Black Wednesday by taking the opposite position of the British government. This is the story of a man who beat an entire national currency due to its knowledge about the markets, and of course, his insane capital power. This is the most famous example of something called market cornering, which is when one major speculator takes control of a market completely. In market cornering, the speculator can decide the direction of such market at certain points, and whoever is in the other side of that market is almost guaranteed to have a bad time like the British government did in the Black Wednesday. The ironic and rather scary thing about all of this is that market cornering is not illegal because it is performed by a completely legitimate mechanism inherent to the markets. Market makers like Soros can tilt the markets at specific points using the supply and demand mechanism that underlies the market. The difference here of course is the knowledge of how to do that, and the capital power to perform such an act. The problem is that traders like Soros have so much money that they can distort the fair supply and demand mechanism of the markets to their favor at specific times. This happens on a daily basis in all markets and in all timeframes in lesser degrees, but market makers are always there waiting to wash retail traders out of their positions. Nowadays, it has become increasingly difficult to perform the act that Soros pulled off in the Black Wednesday because the markets have been receiving an enormous amount of liquidity from retail traders all around the world, so market makers need extraordinarily large positions to affect the course of national currencies like George Soros did in 1992. Just as an example, if you were to move the euro-dollar pair by 1 pip, you would need approximately $100 to $200 million in leverage. That's how deep that market is. Market makers must employ tactics that enable them to whipsaw the market by a few pips, and then they need to take the opposite position again to drive the markets in their desired direction. This can easily become a billion-dollar game, and if the market maker does not know exactly what he is doing, he can lose billions in a matter of hours. However, it is quite difficult to find a market maker that does not know what he is doing because in order to become a speculator of that level, a trader must know his craft perfectly. When we look at these examples of the crazy maneuvers pulled by market makers, we tend to think that they have some sort of unreachable level of privileges and things of the sort. However, as I said earlier in the video, the only difference between market makers and retail traders is knowledge and capital. There is no such thing as different privileges in the market, otherwise all of this would be illegal. However, if you want to trade like a market maker, you don't need their capital power. You only need the knowledge of how they trade. That way you can not only avoid being manipulated by them, but you can also take a ride along with market giants, and use that for your own benefit. Unfortunately, with great power comes great responsibility, so if you want to learn how to trade like the giants, you will need to put a significant amount of effort into it. To close this video, I would like to make a simple analogy that serves to explain how you should see yourself as a trader in the middle of the storm created by market makers and the retail traders. Think of market makers as shepherds and retail traders as sheep. Imagine also that these are the two main players of the market for simplicity's sake. As an aspiring trader, you cannot be a market maker for obvious reasons, and you certainly don't want to be a normal retail trader, otherwise you will not move forward. Using the terms of our analysis, you cannot be the shepherd yet and you certainly don't want to be the sheep. You need to be a third entity in the markets. I like to call this third entity the observer of the herd. The observer of the herd can see what the shepherds are doing to the sheep, so he can anticipate himself to profit from that. The observer of the herd is not influenced by the movement of other sheep. He patiently waits for the correct time to move. The creation of the Market Maker Strategy video course has started, and it will teach you how these wicked market techniques work in real time. Meanwhile, you can learn how to trade consistently by taking advantage of the Fractal Flow Strategy video course, which is going to teach you how to trade using confluence of signals and, perhaps most importantly, how to place your stops in the correct places in order to avoid being caught by the large traders of the market. I'm just trying to spark your curiosity as a trader so we can begin the study of the amazing world of high-level speculation. I'm aware that these videos raise more questions than they answer, but we really need to take our time with this stuff because it is incredibly complicated. If you liked what you learned in this video and would like to see more videos like these in the future, don't forget to subscribe to our channel and leave your feedback below the video. Thanks for watching.